Ask any Indian what they do with their savings, their bonus, their idle cash. 9 out of 10 will say FD. It's the default answer. But there are 17 ways to invest in debt in India, each built for a different goal, different timeline, and a different type of investor. In this video, we break down all 17 so you know exactly which one is right for you. These funds invest in securities like treasury bills and cash equivalents that mature literally the next day. Best for businesses or investors looking to park large surpluses for a day or two instead of leaving them idle. Liquid funds invest in instruments maturing within 91 days, such as treasury bills and certificates of deposit. Best for emergency funds or parking surplus cash for a few weeks or months. These funds invest in securities with an average maturity of 3 to 6 months. They can be useful for upcoming expenses like school fees or a planned vacation. These funds invest in securities with an average maturity of 6 to 12 months. Best for investors who want potentially better returns than a savings account without taking on equity like volatility. These funds invest in money market instruments maturing within 1 year, such as T-bills and commercial paper. Best for parking money for up to a year with relatively low risk. They invest in securities with an average maturity of 1 to 3 years. Best for investors who want safety but slightly better returns than an FD. These funds invest in securities with an average maturity of 3 to 4 years. Best for goals like building a down payment for a car or house over the next few years. Here, the average maturity increases to 4 to 7 years. These funds try to earn from both interest payouts and bond price movements across different interest cycles. These funds invest in securities with maturities above 7 years. Best for investors who want to stay invested for the long term and are okay with some ups and downs in interest rates along the way. This one's different. There is no fixed duration mandate. The fund manager actively moves between short, medium, and long-term securities to navigate changing interest rate cycles. Best for investors who want a fund that adapts to interest rate cycles without a fixed duration commitment. These invest at least 80% of their portfolio in AA plus or above rated bonds. The higher credit quality usually means lower default risk for the investor. Best for investors who want higher credit quality with lower default risk. These funds invest at least 65% of your money in AA and below rated bonds. The return potentially here may be higher, but so is the risk. Suitable for investors comfortable with higher risk. These funds invest at least 80% in bonds issued by banks and public sector institutions like SBI, NHI, and IRFC. Best for conservative investors given their relatively low default risk. These funds invest at least 80% in government securities. Since they are backed by the government, credit risk is virtually zero, although interest rate risk still remains. Best for investors seeking virtually zero credit risk. These funds offer the same sovereign safety as Gilt Funds but maintain an average maturity of exactly 10 years. They are generally more suitable for long-term investors. These funds invest at least 65% in variable rate instruments such as RBI floating rate bonds. Since interest rates reset periodically, they tend to perform better when rates are rising. This is the newest debt fund category introduced by SEBI this year. These funds invest at least 80% in highly rated corporate bonds of a single sector, such as financial services, energy, or infrastructure. But invest in these only if you have a stomach to absorb concentration risk of investing in a particular sector versus a diverse set of sectors. Now, here's a quick reference table of all 17 categories, returns, risk level at a glance. Take a screenshot of this. And that's it for this video. What else do you want us to cover in debt mutual funds? Tell us in the comments and keep following Fixed Returns Academy by Grip Invest.
Fixed returns do not constitute guaranteed or assured returns. Investments in corporate debt securities, municipal debt securities, securitized debt instruments are subject to credit risks, market risks, and default risks, including delay and/or default in payment. Read all the offer-related documents carefully.